Warren Buffett has got a gigantic cash pile on his hands with his investing firm Berkshire Hathaway. As of the latest quarter in 2021, he's got $144 billion on him, just ripe and ready to deploy. With all of this cash on him, you might think that he's buying up stocks left, right and center. But this is not the case at all. In fact, it's quite the opposite. As we can see, he's barely bought any stocks this year, 5 in the first quarter and 4 in the second quarter. And these are all extremely small buys. In fact, if you add all of the buys up together, they make 1.08% of the entire portfolio. That's nothing. Then you look at the stocks that he sold, and it seems that he can't stop unloading the shares that he owns. Add it all up in terms of percentage, he's sold 4 times more stocks compared to what he's bought in 2021. So the question is why? Why is he doing this? Why is he behaving so unusual compared to most investors who can't stop buying? Now, it's not the easiest to find out his personal reasons for doing this because he's been about as quiet as a church mouse recently. He conducted one long interview for his shareholders in May 2021, and that's about all we've heard from him. He's just been keeping it quiet and making his moves silently, tucked away in his office in Omaha. So why? Why is Buffett holding all of this cash, $144 billion, when he could just put it in the stock market? He could put it in something simple like the S&P 500 index, which has been doing so well recently. Over to you, Warren.
On balance, I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. So it has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. We committed $10 billion a week ago, and there are conditions under which, and they're not remote, they're not likely in any given week or month or year, but there are conditions under which we could spend $100 billion very, very quickly. And if we did, if those conditions existed, the capital very well deployed and much better than in an index fund. And we're operating on the basis that we will get chances to deploy capital. They will come in clumps in all likelihood, and they will come when other people don't want to allocate capital.
If we look back throughout history, it gives us big clues as to why Buffett's saving up all of this cash. The somewhat comical thing about the 2008 recession was that while most investors were panicking, having the worst time of their lives, Buffett was in heaven. Stock prices were crashing, house prices were collapsing, everyone basically lost money that year, and Buffett was smiling. Why? Because he could buy stocks at unbelievably cheap prices. Everything was on sale. But what was the one thing that Buffett needed if he was to take advantage of this crisis? He needed cash on him. If he didn't have cash, he wouldn't be able to buy anything. So in 2007, just before the recession hit, he was saving up cash like a madman. He had almost $70 billion in cash, which back then was a lot of money for him. Then when the crash hit in late 2007 and throughout 2008, what do you think he did with his cash pile? He started deploying his cash and was buying up stocks like a madman. Stock prices were just so cheap. And this ended up working out very well for Buffett over the long term. Since the crisis, his stock Berkshire Hathaway is up almost 500%. That's an increase of 6 times in the price of his company. And right now, Buffett is playing the same strategy that he's played throughout most of his investing career. While most investors focus on their short-term gains, Buffett focuses on the long term, and what can we say? It seems to have worked out for him. The other thing that he also mentioned was that he's always looking for those big business opportunities that come along very rarely. But when they do come along, he needs a lot of cash. He needs tens, if not hundreds of billions to buy elephant companies. For example, in 1972, Buffett needed a lot of money, at least back in those days, to buy See's Candy. He bought the company outright for $25 million, again, a lot of money back in the day, but it paid off. In 2020, last year, See's Candy made $383 million in sales and $82 million in profit. So the yearly profit is now more than triple the amounts that he originally paid for the business outright. If Buffett had not kept cash on the sidelines, he wouldn't have been able to buy the business outright, and he wouldn't have made all of that money. Buffett needs the big cash pile for what he calls his elephant gun. It's just in case a big business comes along, selling for a bargain, Buffett needs it on hand to snap it up. But there's also more reasons behind the cash pile and the lack of buying stocks. I'll let Charlie Munger explain.
Well, I plead guilty to being a little more conservative with the cash than other people, but I think that's all right. We could have put all the money into a lot of securities that would have done better than the S&P with 20/20 hindsight. Remember, we had all that extra cash all that period if something had come along in the way of opportunities and so on. I don't think it's a sin to be a little strong on cash when you're as big a company as we are. We don't have to. I watched Harvard use the last ounce of their cash, including all their prepaid tuition from the parents, and plunge it into the market at exactly the wrong moment and make a lot of forward commitments to private equity. They suffered like 2 or 3 years of absolute agony. We don't want to be like Harvard.
Plus timber and a whole bunch of things.
What?
Plus timber and
we're not going to change.
The thing is, Charlie Munger and Warren Buffett, during these times when prices are so high, they play the game more conservatively compared to most investors. And it doesn't look good in the short term, because everyone says, look at all of the profit that you've missed out on. You guys are silly. The S&P 500 has gained 90% in just over a year, and you have had your money in cash? But Munger says, listen, if we look back throughout history, there's been plenty of times where people who have been burned because they invested all of their money at the top of the market. Harvard, supposedly the place where all of the smartest minds congregate, they fell for this too. They plunged their money over a decade ago into a very pricey stock market. They used their cash to buy stocks, to buy bonds, to buy hedge funds and private equity, and you can guess what happened. The market crashed and Harvard suffered badly. They had to tighten their budgets, they had to defer expansion plans, they had big interest payments on bonds issued to cover their losses. It was bad. James F. Rothenberg, Harvard's treasurer, said, "The biggest mistake was not to take in some of the cash off the table and placed it into safer accounts as trouble started brewing in the markets and the economy. We all can look back now and say we wish we did something different." So a lot of people are looking at Buffett's strategy now and saying, you're missing out on all of these profits, but Buffett is doing this for a reason.
We do like having a lot of money to be able to operate very fast and very big. And in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold and all you have to do is go outside. But we don't know when they will happen. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money for anybody that buys our stock somewhere around intrinsic business value to begin with.
There are times in history where, quite frankly, it has rained gold, aka there are investments out there that are basically giving away free money. 1949, as the world was starting to come out of the Second World War and starting to build, this was a great opportunity to invest. Most businesses in the stock market that you could have bought would have taken off. In fact, if you invested $100 into the S&P 500 at the beginning of 1949, that $100 would have bloomed into $521 just 10 years later. It was raining gold. Even a more recent example that I like is what happened in 2020 with oil. With the global shutdown and transportation and travel stopping, oil prices fell off a cliff. They went from $65 to $20 in 4 months. This was obviously a great opportunity to buy oil, and I actually made a video on it back then. There was just so much money to be made, and to be honest, it was quite obvious. It was figuratively raining gold, or raining oil, I guess you could say. The point is that there have always been opportunities throughout time where there has been easy money to be made, but the one thing that you need though is the cash on the sidelines, or else you will miss out. And Buffett knows this more than anyone, and that's why he's got so much money in cash on the sidelines.